What are closing costs? Well, I'm glad you asked. Welcome back to the channel. My name is Gavin Sessions with Loans Made Simple. If you're curious to learn about all things related to mortgage and home loans, subscribe to our channel. We post new content each week. If you're ready to get qualified for a home loan or get connected to a great real estate agent, check the description below or leave us a comment. We'll be down there getting to your comments ASAP. So as I mentioned, this video is all about closing costs. And I think a lot of borrowers, if they're honest, have probably never even heard of closing costs. And if they're just getting into the home buying process, they probably aren't even aware that closing costs are a thing. So closing costs are a bit of a junk drawer term for any cost or prepaid item or fee that you pay at the closing of a home loan to purchase a house. When you're thinking about closing costs, they can be a little bit hard to understand or a bit ethereal. So I thought, what better way to describe and explain what closing costs are versus looking at an actual closing disclosure here. So that's what we're going to do for the next few minutes, is walk through an actual closing disclosure. This was real, but of course we've redacted any of the information that would be private in nature. But yeah, we're just going to kind of jump in and talk through each of the line items for the most part, explain what closing costs prepaid items are. And ideally by the end of this conversation, the end of this video, you're going to have a great idea of what to expect when you do purchase a home and when you do have to pay closing costs, and you'll remember seeing this document. Starting right here at the top, we've got the closing disclosure title. We've got dates here. So the date this document was issued, we've got the closing date here, which would be July 7th of 23, and the disbursement date. So this closing, the signing actually happened July 7th, and the disbursement, when the transaction was funded and recorded, actually happened on the 12th of July. So I got a line through it. Maybe just clean that up just a little bit here. We'll get back to our pen. There you go. So the settlement agent would be the title and escrow company that you've chosen to work with. And typically as the buyer, you have the opportunity to choose the title company if you choose, but it's usually very unlikely that that will be the case. Typically the agents are going to recommend the title company, and usually as the buyer, you really don't care. So anyhow, we've got just kind of generic title and escrow company here. We've got a file number that doesn't mean anything. We'll kind of jump down in here to the address of the property. So that's property right there, the 3996 Palace Place in Frisco, Idaho. Cool. And then we've got a purchase price of $425. We're just going to kind of erase some of this stuff to clean it up as we get through it. So purchase price $425. And this, we'll kind of just moving it from left to right here. So we've got the borrower here, the borrower's name. We've got the seller as well. And then of course the lender, your lender of choice, whoever that might be. Over here to the right, we've got the product, the loan information here. So this is a 30-year fixed. This is a purchase. There's a fixed rate. This is a conventional mortgage. And then we'll just kind of jump into it. So here are the loan terms. Loan amount on this $425 purchase is a $325,000 loan amount. So $100,000 is the down payment. Simple math there. Interest rate on this 30-year fixed, 6.5%. which gives us a monthly principal and interest payment of $2,054.22. So one thing to note, that payment will never change for the life of this loan. Now that's the principal and interest portion of the payment. As we get down a little bit here, we'll see some of the taxes and insurance that'll also be included in that payment. But prepayment penalty here, very uncommon for any loan for the purchase of a home to have a prepayment penalty with it. Conventional loans almost never have a prepayment penalty. So that basically means you can pay the loan off early, or you can refinance it really anytime without any penalty to you at all. So that says no prepayment penalty, no balloon, meaning that, well, probably honestly a better thing to explain for another video, but no balloon payment on this one. All right, so principal and interest, again, right here, $2,054.22. This loan does not have mortgage insurance because it has a $100,000 down payment on a $425 purchase, meaning the loan to value is less than 80%. We'll again talk about mortgage insurance in detail on another video, but no mortgage insurance on this one. Estimated escrows, this would be your taxes and your insurance that are being paid through an escrow account on your behalf. So again, potentially other video will explain an escrow account further in detail, but generally speaking, almost every mortgage transaction has an escrow account where your taxes and your insurance are paid on your behalf. So taxes, depending on where you're at in the country, are going to be due at different times during the year. But the escrow account will capture 1/12 of those annual taxes and will basically be a forced savings account for you. And that escrow account then will pay those taxes as they come due, depending on the county or the city or just the local authority, if that makes sense. Your homeowner's insurance is paid once per year. So each mortgage payment you have will include 1/12 of your homeowner's insurance, and then that will be paid on your behalf once per year at the renewal. So let's just say this house, we'll go back right up to the top. So this one closed in July. So at closing, we would collect homeowner's insurance in July to get us through all of to get us through all the remainder of 2023 and up through June of 2024. Then in July of 24, the homeowner's insurance would renew and that escrow account would have money in it to pay that renewal at that time. All right, moving on. So total payment here with principal and interest of $2,054 plus taxes and insurance of $653 gives us that $2,707.54. All right, moving right along. This next number here is $715.82, slightly more than the $653 here. And that is because it says it includes HOA dues, right? So your HOA dues are almost never paid through an escrow account, but they are part of this number here. So 715 less 653, if you did that math, it would tell you how much your monthly HOA dues are. All right, moving on. So total closing costs for this transaction, this here is page 1 of the closing disclosure, $11,342.43. And then cash to close is the amount that you as the borrower would bring to the closing table, either with a cashier's check or a wire, $93,287.31 here. If we go right back up to the top and we say, hey, we had a $425 sale price right there, and we have a $325 loan amount, simple math says that the cash to close should be about $100,000, right? Well, that would be true if there were no closing costs. And that would also be true if earnest money had not been deposited already. So this is the final cash to close amount. As we walk through the next few pages of this document, we'll understand why the cash to close is what it is. So, all right, moving on here to the meat and potatoes, page 2, this is where we have the line item. So closing disclosures are going to be broken out by letters. And so box A here is your origination charges. And these are where you're going to see charges such as like processing, underwriting, if you decided to pay discount points. So this particular loan had 0.5% of the loan amount. So loan amount was $325,000. 1% would be $3,250. 0.5% here is $1,625. Processing fees, what the lender's charging here of $495. And then we've got an underwriting fee of $545, and then we have a wire fee of $35. Those fees add up to $2,700. Borrower paid. All right, keep moving down here. The next section is letter B, and these are services that the borrower did not shop for and frankly is really not able to shop for. So this would be your appraisal fee, which here is $500. We've got an attorney doc prep fee. So this particular lender hires an attorney to prepare their final documents. $150. Credit report fee. So every time you apply for a mortgage, you're going to have a credit report pulled for you by a third-party provider, right? The lender is not actually able to pull the credit themselves. They use a third-party provider that here costs $93. The flood cert fee, very standard for almost every transaction, right about $10 there. And that is basically to determine if your property is located in a floodplain or not. And then a tax service fee of $75. All right. Moving right along here. So box C, these are fees and line items that you're actually able to shop for if you chose to. This is where we're going to see our title fees generally. Like I said, most borrowers don't have a preference of the title or escrow company that will be used to settle their transaction. And if you did have a preference, you certainly would be able to share that with your real estate agent, and that could be taken into account as you guys make your offer. And would be decided at that time. So you have the ability to shop. Most borrowers don't shop. Title fees generally are really similar from one company to the next, title and escrow fees. So we'll kind of go through all these here. So we've got a title fee of $25. And let me just back up real quickly. Most of these are going to be third-party fees, meaning they're not fees that are charged by your lender, or in other words, your lender is not getting the funds as those fees are paid. Let me just kind of erase some of this stuff to keep us cleaned up as we keep going here. So, okay, third-party title fees. So we've got a closing protection letter. We've got a courier fee. We have an e-doc fee. We have an endorsement fee. We have an e-recording fee. We've got a lender's title insurance policy. So most of these little fees are probably honestly not worth most of our time explaining, but these bigger ones are certainly worth a couple of minutes or just a bit more of a pause. So, all right, so jumping back in here, let's just spend a very brief moment explaining what title insurance is. Title insurance is kind of like a credit report for the house. It basically will tell us the history of the property as it's been bought or sold or changed hands, or if someone's made a claim against your property, or the property, I should say, and they think that they own a part of it, or potentially the survey lines may be off, anything along those lines. So what title insurance does is it protects you, it protects your property from claims by another person or another entity that would say that they own your property. So title insurance is paid once, it lasts for the life of ownership of the property, and it defends you as the homeowner against any attacks on the property's title. Basically, when your mortgage is recorded against the property's title, it's recorded in the first lien position. So when you go buy a house, the title commitment proves that the title history, that the current title is clean. All right, moving on from title insurance, there's a notary fee of $225, a settlement closing fee. So you can see here that if I zoom out just a little bit, this is the seller column here. This is the borrower column here. One of the very standard and customary fees that you split with the seller is the closing, highlight it here, the title settlement and closing and escrow fee. So in this case, it's a total of $1,300. We've got $650 on the buyer side and $650 on the seller's side. And then last but not least, a wire fee of $20 there. All right, so total costs here through boxes A, B, and C, $64.27 on the buyer side, and then the seller side total will kind of be down further this way. All right, moving right along here. So these are other costs. We'll go to box E here. We've got recording fees for the deed and the mortgage with the county, $60 here in this circumstance. Those fees can vary, and they do vary, frankly, depending on the county that you're in. Prepaids, awesome. Jumping into prepaids here. So we had talked briefly about homeowners insurance and how it's paid on your behalf through an escrow account, typically once per year. So homeowners insurance premium for 12 months here, $1,669. I won't do the math for you and what that works out to per month, but it's somewhere, we're probably around $120. So that's that. You're going to prepay that. And then with each mortgage payment, so if we were going back to the top of this document, we close in July. First payment would be due in September, and that's because the way that interest is accrued. So first payment in September would include 1/12 of the homeowner's insurance, and then that would those funds would sit in that escrow account and accrue such that when we hit July of next year, we're actually going to have enough money in that escrow account to pay that premium, that $1,669 when it comes due next year. Prepaid interest. So this is from the day that we close through the end of the month, and that has to do with what I just mentioned a second ago. So mortgage payments are paid in arrears as interest accrues. So through the end of the month, so July 12th was the day we closed, and through August 1st is $1,157.60 of interest. And you're wondering if you wonder where that comes from, you go back up, and we have a $325,000 loan amount, 6.5% interest. So the daily interest times however many amount of days, daily interest right here, $57.88 times this amount of days is that prepaid interest. So that is collected at closing. And that gets us through the end of July. Like I mentioned, your first payment is going to be in September, and it will be for the interest that accrues in the month of August. So interest will accrue in August. The payment will be due in arrears in early September. All right, continuing forward. So we talked about escrow accounts already. Because we're closing in July and your first payment is not due until September, but your insurance will actually be due for renewal in July. If you do that math, we're going to miss a payment there. So we have to collect 2 months of homeowners insurance to build the reserves in your escrow account such that when the renewal comes due in July of next year, there's enough money in it to pay that renewal. So 2 months worth of insurance at $139 a month. There's the math there. So the policy was $1,669. Here's the monthly expense for insurance, $139.08. Probably good for me to note right here that homeowners insurance is something that you are responsible to shop for. Your agent and or lender will have plenty of recommendations to great insurance agents. But if you already have one that you like and you're already doing business with, maybe as a renter or maybe for your auto insurance, great place to start is just to contact that agent and ask them for a quote on homeowners insurance. And then you can select whichever coverage is sufficient. and then your lender will work directly with your homeowner's insurance agent to get the appropriate documentation and get that insurance policy bound to the mortgage. Just want to pause the video for a quick moment and invite you to connect with us. If you're ready to take the next step to get qualified and speak to a mortgage professional, a loan officer, or if you'd like to get connected to a great real estate agent, click the links below. All right, so collecting some reserves there for your escrow account, $278.16, 2 months worth of reserves. Property taxes. So the reserves for taxes here the reserves for taxes in general are going to be dependent on when taxes are due. So I know this transaction happened in Idaho because it set it right up the top. Taxes in Idaho are actually due 6 months in arrears, and they're paid twice a year. So they're paid in June and they're paid in December. So with a July closing, we're going to collect 3 months worth of taxes so that we have enough reserves in the escrow account to pay the taxes when they come due in December. All right, so 3 months there, $1,542.72. All right, aggregate adjustment. This is an automatic calculation that is done to ensure that your escrow account does not have too much of a surplus in it. So we calculated the reserves needed to pay these taxes and insurance when they come due. And the system says, hey, you've got too much in there. And so there's a adjustment of $514 back to you, which will reduce that column there, which will reduce the total for box G. So, all right, moving right along, this particular property has HOA. And so at closing, there are some prorated HOA dues that are due, $421. And I kind of crossed through that, so apologize. And then this HOA also has a new owner setup charge of $300. So that's that. Every HOA is different. How they bill is different. Some will bill monthly, some will bill quarterly, some will bill twice a year, some will bill once a year. Some will require these prorations or transfer or setup fees at closing. It really just depends on that particular HOA. Moving right along here. Oh, we've got something that's a fairly large line item, $2,665. That's the owner's title policy. Again, back to our title insurance conversation. Remember, title insurance protects the property against claims made against the property where somebody or something might say that they own part or all of your property or have some sort of stake in your property. Your title insurance protects you from that. What's very customary is that the seller of the property pays for the owner's title policy. So if you can see that $2,665 charge is actually on the seller's side. All right. This would be a subtotal of boxes E, F, G, and H. So that's $49.14. And then we've got our total. So we're going to add this $49.14 to this $64.27 there. And we're going to end up with total closing costs of $11,342.43. If there were any lender credits, that's where those would be. This is a summation of the fees on the seller side. So we've got the owner's title policy of $26.65 plus half of the closing escrow fee. That's paid by the seller, and that comes up with a total for the seller of $33.15. Now, the seller doesn't necessarily write a check for those fees at closing. Those fees would come out of the seller's proceeds. Hopefully that makes sense. All right, moving right along here. On to page 3, calculating our cash to close. So the cool thing about a closing disclosure is the format, if we go back to page 1, looks very similar to a document called the loan estimate that you will get as part of your initial disclosure package as soon as you go under contract to purchase a home. So the closing disclosure is meant to look very similar to the initial loan estimate. And when you see that, you will notice it. So this next part just basically compares the loan estimate to the final, which is what we're walking through here, the final closing disclosure. Just erasing some of this bad annotating here. So we've got total closing costs that were estimated initially at $11,542. And guess what? The final $11,342, we're only off by a couple $100, and we're off by a couple $100 in the right direction. We love it as lenders that our estimates are accurate and or even that the final numbers are better than what the estimates were. That's our goal, right? It'd be awful if estimated fees were $11,542 and final was $16,000, right? You'd never be surprised with that at the closing table, but we want to estimate really well on the front end such that when we get to the closing that our estimates were accurate and your fees, that your closing costs are exactly what you thought they would be. So, all right, moving right along. So closing costs paid before closing, none. Closing costs financed, in this case, none. And financed would mean like you added them into your loan amount. That's fairly uncommon. So none in this case. Down payment, here's that 100,000 we talked about, estimated at 100 on the loan estimate, and then of course did not change 100 here. Deposit, so this is the borrower's earnest money. So when you buy a home and you tell a seller that you are serious about buying their home, what you do is you write an offer, and part of your offer will include something called earnest money. And that basically tells the seller that, hey, I'm super serious about buying this house such that I'm willing to put some of my own money down. Now, that earnest money is somewhat at risk, but not without contingencies, right? So typically earnest money will be contingent on the inspection of the property, meaning you're going to hire an inspector to come kind of, if it was a car, basically to look under the hood of the car and give it a thorough check. They're going to look in the attic, they're going to look in the crawl space, they're going to review anything and everything that they possibly can, and then provide you a comprehensive report. Now, if that report comes back in good shape, then you're going to feel great about moving forward and you'll waive your inspection contingency, meaning that your earnest money is slightly more at risk than it was, right? The next place that your earnest money is contingent on would be the appraisal, right? So the appraisal is what the lender hires, and the appraisal charge was here. It was this $500 charge. You don't get to choose who your appraiser is. The lender has a panel that they typically will work through, and they hire a third-party appraiser who's not an employee of the lender, and they will come out, and their job is frankly to provide you the market value for the property as compared to similar properties of age and radius, so location. Basically, your property that you're buying and the purchase price that you agreed to with the seller has to be similar and comparable to other homes that have sold in the area, right? So as long as the appraisal comes back in at value, then you would waive your appraisal contingency. In the chance that the appraisal came in low, so for this house, right, $425 is our purchase price. Ideally, we're going to get an appraisal right around $425. If the appraisal would have come back low at $420, for example, you technically, as the buyer, would say, well, my earnest money was contingent on the appraisal coming back at value. It didn't. That would give you an opportunity to terminate the contract if you chose to, and then you could walk away and get a refund of your earnest money. In this case, the earnest money was $16,500. Last but not least, the final contingency that would allow you to get a refund of your earnest money if you walked away would be the underwriting contingency or the financing contingency. So most people can't buy a house without a loan. So their earnest money they put down will be contingent on inspection like we talked about, appraisal like we talked about, and then last but not least, it will be contingent on an underwriting approval, right? So since most people can't buy a house without a loan, if they don't get a loan approval, they're not able to buy the house, right? So long story short, you would never find out about your loan not being approved on the closing disclosure at the closing table. But since we were talking about earnest money, it kind of just made sense. So assuming, well, in this case, this loan was approved. So then this borrower would then waive their underwriting or financing contingency and we'd move forward, right? So, all right, continuing on here, that's earnest money, also called deposit. Funds for the borrower, zero. In this case, seller credits $650 here. That was on the initial loan estimate, showing zero here on the final. So seller credits right here on the loan estimate were $650, and that's half of that $1,300 closing escrow fee. On the final, we've just moved that right over here to the seller's side as a charge to the seller, so it doesn't become a credit necessarily. So cash to close was initially estimated on the loan estimate at $93,079. And here on the final, $93,287.31. Very, very close and certainly within the margin of error there. All right, so this is just a bit of a summary, a different way to look at it. So this is what is due from the borrower. So the borrower is purchasing the property at $425. Here's the borrower's closing costs at $11,342. We've gone through in detail what all those closing costs are. We've got some HOA dues that are going to be prorated and due as well. So the three of these charges together, $436,773.94. That's what the borrower owes. The next section here is credits, and that would be the earnest money of $16,500. We've got our loan amount, which is a credit here of $325,000. We've got a title premium adjustment. This is where we're getting a credit for the lender's title insurance policy here of $1,313. And then last but not least, we've got a credit for county taxes based on the way that this county pays taxes. So that comes back where basically the homeowner didn't own the house from this period of time, right? They bought the house after July 10th. And so therefore the taxes that are due from that time period would be $673 paid by the seller, which becomes a credit here at closing. So if we add these things up, we've got total credits of $343, $486, 63 cents. And then subtracting that amount from what is owed here, this $436, less our credits, gives us our final cash to close of $93,287 and 31 cents. All right, so this is a really good example of the closing costs you could expect. And again, the costs are gonna vary by area, by state, by county, as well as based on the time of the month that you close, based on the way that prepaid interest is collected. But if we take the total closing costs of $11,342 and we divide it by our purchase price of $425, we end up with closing costs in the amount of about 2.5%. So good rule of thumb as a home buyer is, hey, we'll probably have closing costs of about 2 to 2.5%, depending on the area, of course, right? And depending on when taxes are due and depending on the time of the month that you close. If you close on your home purchase later in the month, there's actually less prepaid interest to collect, right? But that also means you'll hit your first payment a little bit sooner. So it's kind of 6 one way, half a dozen the other. But you can see if this transaction closed later in July, we would have collected less prepaid interest per day at $57.88, which would have been, a smaller charge here. But like I said, kind of 6 one way, half a dozen the other. The first payment will hit sooner if you close the loan later in the month. As we kind of move forward with this closing disclosure, this next page really isn't about your closing costs. So we're kind of, for the sake of this video, we'll move through that. Kind of the last thing I want to call out on this closing disclosure is the APR, which is the annual percentage rate. So you can see that right here. The APR is your costs over the loan term expressed as an interest rate. So this is not your interest rate, and in this case, 6.617. So we know the interest rate was 6.5%, right? So we know that our cost of credit has to at least be 6.5%. But we also have these other costs, right? So 11,342 of costs. If we add some of those costs, now I'm not going to calculate the APR here. Not everything is included in the APR, but some things are, right? So if we add the costs that are included in the APR and we express those costs along with the interest rate as a percentage, we end up with an APR calculation here, annual percentage rate of 6.617, so slightly higher than the 6.5% interest rate. Now, this is a really great calculation to compare loan estimates or to compare a closing disclosure. Hopefully it's a loan estimate, right? Because hopefully you're doing your comparisons on the front end. But every time you get a loan estimate, you're gonna get this detail, right? Everything we just talked through here. And then it's gonna tell you at the bottom what the APR is. So it's really easy to compare one lender's loan estimate to another lender's loan estimate because you know your loan amounts, right? You know your purchase price, you know your interest rate. And then if you see the APR, let's say the APR on this loan is 6.617%. Let's say if you were still in the shopping phase and you looked at two different loan estimates, this one's 6.617. Let's say the other estimate you saw was 6.75% for the APR. It's really easy to say, well, 6.75 is more expensive. The interest rate's the same, the loan amount's the same, the purchase price is the same. So therefore, the APR of 6.671 is cheaper. I'm gonna go with that one. It's less, right? That loan costs me less, if that makes sense. So our hope is that this video answered all of your questions about closing costs. And if not, leave us a comment. We'll be quick to get responses to your comments and your questions, and we'll catch you on the next video.